Hi everyone, Dr. Brown here, and good Sunday morning. I got my tea. Uh, Back in Russia, getting ready for the new semester and starting my classes already. So you can see that I'm still getting over the jet lag and just kind of trying to recover from all of the travel that I was doing there. Uh, I wanted to talk today about what's happening with this whole GameStop issue, what it means, what's kind of going on. I'm going to preface this, of course, with a bit of a disclaimer. So, I own some of BlackBerry, have for many, many years. So, that's one of the stocks that is kind of going through this weird process. So, take that as you will, as full disclosure. Secondly, I'm not an accredited stock trader. There's no credentials to what's happening here at all. If you're going to be doing any sort of trading, find yourself a good financial advisor, figure that out for yourself. But I thought I would talk about it from the perspective of kind of what is happening in the games side of it, and also kind of what's happening with the what are these weird words like hedge fund and short selling. And so that's why I'm going to kind of see this as kind of more of an educational piece of what are these terms, what does it mean, and I'll leave kind of the what does this mean in terms of is this legal, is this illegal to people who know better than me in regards to that. Okay, so to start out, what exactly is a hedge fund? Well, to start out, even before that, what's a hedge? So the idea here, imagine that you are a hockey card collector. Okay. And so here I've got this Tim Hortons hockey card of Joe Thornton, which is going to be my example for pretty much everything in this video. So here we have Joe Thornton. Say that you're in the business of goals for the Sharks. And your job is to just make a bunch of goals for the Sharks. And as the Sharks goals go up, Joe Thornton's stock rises. So the price of this hockey card goes up. Say it's about $1. Conversely, the price of Joe Thornton's hockey card could go down. Maybe Joe Thornton jumps over to the Leafs like he did, or maybe he ends up on some other team, or he's not really producing this year. So his hockey card price maybe goes down. So here's the issue. If my entire business is based around how Joe Thornton's doing, I'm not very diversified. I've got some problems. So maybe I would like to hedge my position. I want to take a secondary position that is against Joe Thornton, somebody else, some other hockey player. Even though I'm in the business of producing Joe Thorntons, maybe I want to buy some stock somewhere else. Maybe I want to, have Carey Price over here, who's a goaltender on the Canadians. And maybe he, because he's a goal scorer, he's a goal defender. So maybe that's the opposite of the trade. You might wonder, for example, why are oil companies some of the biggest investors inside of green energy? And the truth there is really simple. It's a hedge. They want to buy something that's opposite to their business so that way if their business goes down, then the green energy will go up. And but conversely, if their business goes up, green energy might go down. So what you're doing is you're trying to stabilize the price. Hedge funds were originally created as a mechanism to do this. The problem with this is that hedge funds went beyond what they were originally supposed to do inside of the financial markets. We saw this with credit default swaps as well, that there was this kind of creation of these extraneous bits, and then you had swaps of swaps and swaps. Go watch The Big Short if you want a further examination of that. And Harley Quinn's actress inside of a tub. But the big piece inside of all of this to take away is that hedge funds were originally created in order to basically protect or insure certain investments. The problem is that the creation of these hedge funds led to a whole bunch of capital inside of sectors not regulated by the SEC. So there's the Securities and Exchange Commission, which you might have heard of a few times in all of this, and they regulate basically what a investment bank, or in this case also a mutual fund, is allowed to do. Hedge funds do not have these types of regulations, the idea being that only sophisticated investors are supposed to get into them, bigger corporations, people with lots of money. So what's happened is that this hedge fund has gone in there and they have said that they believe that GameStop is probably going to go out of business because, well, people are not buying games in brick and mortar stores during a massive global pandemic. And because of this, they've come in here and they have bought the stock short. Okay, so what does short mean? So probably everybody is familiar with buying something long. I have this Joe Thornton hockey card. I went in, I put down some money, and now I have this stock, this piece of hockey card. Here's the issue with this. That assumes that I am going to think that this is going to go up in future, right? Buy low, sell high. What if I thought that Joe Thornton was not going to play so well this year? That's a bit of a quandary, right? Because why would I want to then buy Joe Thornton stock? What I would want to do is basically somehow say, no, Joe Thornton's going to go down and make the profit on that somehow. Well, what I could do is go to someone else, say, can I borrow your Joe Thornton hockey card? I then go onto the open market, I sell the hockey card of Joe Thornton. So now I owe a hockey card of Joe Thornton to someone, but I have the money of Joe Thornton. If in a month's time I go out and I purchase a new Joe Thornton and the price has gone down, I pocket the difference. So if this hockey card was $1 and I borrow it from you, I sell it on the open market, I now have $1. I go back into the open market a month later, buy it for 50 cents, I've pocketed 50 cents and can give you back the hockey card. Now the question is, why would you want to let me borrow it? Well, maybe I give you a certain amount to do that. There's some other, monetary instrument that allows me to borrow that at a certain price. And given that, if Joe Thornton goes down, I've given you a small amount of money for that. Or even if it goes up, maybe you still wanted to hold on. You think Joe Thornton is going higher again. So because of this, we have this kind of trading, and this is known as a short sale. You are selling without the thing, with it short. That leads to it making profit on the downwards side of this. Now, there's a bit of an issue here. If I buy a Joe Thornton hockey card for $1 and it goes down to 0, I've lost $1. If I short sell a Joe Thornton hockey card and it goes to $2, so I bought it, but basically borrowed and sold it for $1, I now have to go in the market and buy it for $2. I've lost $1. What if it goes to 3 or 4 or 5 or 178? You can see that the high risk in a short sale is that the price can continue to go up, potentially and theoretically infinitely, but within a reasonable amount. And on the low side, I can only lose whatever I put in. This is one of the reasons why the majority of investors do not touch shorts, or are pretty much not allowed to touch shorts. So what has happened here is that they have gone onto the open market, this hedge fund. They have borrowed pretty much all the Joe Thorntons that they can get. They've sold them onto the market. And in the act of even selling them onto the market, more Joe Thorntons came onto the market. And so they also took those and resold those again. So you can see that you're now leveraging up because you're creating phantom Joe Thorntons. So you can owe an infinite amount of Joe Thorntons to someone, but there could still only be one Joe Thornton. And what happened was a group on Reddit realized this. They looked at some of the public filings of these companies and found that they had huge, giant positions in GameStop on the short side. Now, here's the question. What do you do if you realize this information? Well, you buy a lot of them. If I knew that you owed 15 Joe Thorntons, if I can go and buy a whole bunch of Joe Thorntons on the open market and hold on to them and not allow you to borrow them, then what I can do is squeeze you, what's known as a short squeeze. And so what happened was a bunch of institutional small-time investors went onto the market and bought up a whole bunch of GameStop stock in order to go in and basically make it so the short sellers could not find enough to cover their position. So, in other words, to buy back. And because of this, the price went up and up and up and up. And a lot of these smaller time investors made money off of this massive hedge fund, which actually went bankrupt because of their position. So now what we're seeing is a whole bunch of people crying, mostly billionaires, saying that it was unfair that this group got together on Reddit and were able to figure out their position and bet against their position. Because it isn't about the underlying product. In this case, it's a Joe Thornton hockey card. In their case, it was GameStop. It's just that they figured out how to play the game inside of this and figured out that that's the thing. Here's the issue with this. One, so a lot of these big giant market makers corner these positions all the time. This is basically what hedge funds have been doing for years and years and years. And there's been bunches of these examples of these companies buying stuff up and forcing other companies into a position to basically extract this money via a short squeeze. The other piece of this is these are supposed to be the smart guys. These are the ones that the SEC says, well, they know what they're doing. And they got beat by a bunch of mom and pop and small time investors on Reddit. And in fact, quite a few people made sizable amounts of money doing this, to the point that I think it was like $13 billion was extracted from this one hedge fund. And in fact, they have now been bailed out multiple times in order to try to cover these positions and losses. A few other things happened, like Robinhood's paused trading in the one direction. So as you go forward with this, that's pretty much the definition of the terms. So short selling is when I borrow some off of you, and then I basically pay you back the item later with a certain amount of hope that the price will go down in the interim. And hedging is basically betting against oneself as a form of insurance. So if I believe that oil is going, if I'm an oil company and I believe that oil might go down, I might want to get into green energy or something like that. So I hope that that clarifies some of the terms that are happening right now. I think this is going to be a very interesting thing to watch going forward. But I really don't think that it actually affects on kind of the game industry as the whole, or whether it actually will even save the company of GameStop. Because it's not as if the brick and mortar store was doing better because the stock price was being bashed about in all of these different directions. This really amounts to not just playing the game, but playing the man. And for those of you that are familiar with any sort of game theory, sometimes the question is not just, is this better for me within the confines of the game, or is this something that makes rational sense from that perspective? The other piece of this is knowing who you're playing against and what their outcomes are. So this might be market manipulation, but given the sides involved, it kind of happens. And for those of you that are saying, well, this violates the efficient market hypothesis, if you see an opponent giving you a huge, giant short position to the point where you can extract capital out of them, how is that not an efficient market to go and exploit that arbitrage situation? So I think the market is correcting itself. Anyways, that's my Sunday morning thoughts on what is going on with GameStop. You can basically click around and see more of my videos. In fact, take a look at maybe my 14 days of enforced quarantine in Canada. And as always, stay safe and wash your hands.